Well, good afternoon, everybody, and good morning to those of you that are in either Queensland or WA. My absolute pleasure today to be welcoming again Tim Lawless from CoreLogic, who is going to run through the latest data from CoreLogic about the state of and the prognosis for the Australian residential property market. Certainly here from the agency, it's been a fascinating last few months where we've seen different parts of the country performing very, very differently at different rates of speed and indeed in different directions in terms of both prices and also volume of transactions. Indeed, I was lucky enough to be over in Perth for the majority of last week. And what is happening there in their marketplace is very, very different to what's happening over here on the eastern seaboard. One of the benefits, I guess, of being a national brand or a national business, we get to see different things happening in different markets all around the country. And our people obviously benefit from that. But Tim and his team at CoreLogic see it at a far greater granular level. And for that reason, we have a very strong partnership and we enjoy that partnership and relationship with CoreLogic. And I know I always enjoy seeing the data pack come from Tim and getting on the telephone to discuss that. So today we've got a presentation by Tim of about 30 minutes, and after which we will open up for about 5 or 10 minutes of questions and answers via the chat facility that you've got through your login. So without further ado, and thank you again, Tim, I'd like to hand over to you for your presentation.
Great. Thank you, Jeff. It's such a pleasure to be here as well. Thanks for inviting me along. I'm dialing in from Southeast Queensland, and I'm happy to say, or maybe I'm not happy to say, this is the first time I've had to put the air conditioner on in my home office. It is cracking hot, and all the rain we've had have just made it really humid. The housing market, not quite as hot, I guess, is a good segue, but starting to see a few glimmers of maybe the rate of decline starting to show an easing trend over the past couple of months. So that's encouraging to some extent, and also we are seeing activity looking like it's starting to level out at around average levels as well. So what I'd like to cover in the next 30 minutes is an update on what we're seeing in housing values, in market activity, so listings and transactional activity, touching on the rental markets, which are operating very differently. We're seeing rental markets remaining extraordinarily tight, and then a bit of a wrap on where to from here, which of course is in many ways highly uncertain, but I'll give it a go. So let's start with the value side of things. I'm going to start really macro. So looking at a national graph here and tracking the month-to-month change in our national home value index and focusing on the COVID period to date. So pretty much from about March 2020 through to September 22. And you can see there's some really interesting inflection points here. Absolutely, we are seeing housing values falling. They have been since the first rate hike back on May 3rd. But importantly, there was already an easing trend in the marketplace leading up to the first rate hike. And a reminder about some of those factors that were contributing to that slowdown in the rate of growth. It was things like affordability becoming more challenging. It was fixed mortgage rates rising from early 2021. APRA coming in and upping their serviceability buffer by another 50 basis points to 3 percentage points. But of course, as we started to see inflation really picking up and then interest rates moving higher from their emergency lows, that really was an inflection point in the market. And you can see that more clearly if we start to look at the 5 major capital cities and looking at the rolling 4-month change in our index. You can see what happened on May 3rd. The markets were already easing in value. Sydney and Melbourne, we're already seeing housing values falling in both of those markets before interest rates started to rise. You can see their rate of decline really sharpened quite substantially. And then markets like Brisbane, to a lesser extent Adelaide and Perth, started to see a slowdown in the rate of growth with Brisbane ultimately moving into a decline phase about a month after interest rates rose. And Adelaide and Perth, of course, stabilizing is probably the best way to describe those markets. You can see quite clearly values in both Adelaide and Perth are only down about 0.5% to 0.8% since those markets moved through a record high, a record high back in around about July or August of this year. The other really interesting factoid from this rolling 4-week graph is when you look at the trend over the most recent couple of months. And to my point in the introduction, you can see that rate of decline is just starting to ease off a little. So Sydney, for example, at the end of August, was seeing housing values falling at about 2.2% month on month. That's now improved to about 1.2% month on month. Melbourne, you can see values there were falling about 1.8% month on month. Now that's down to a little bit less than 1% month on month. Brisbane looks to have stabilized at a fairly swift pace of decline, but still at around 1.8%. And Brisbane, of the 5 major capital cities, is now recording the fastest rate of month-on-month decline, although it's probably just playing a bit of catch-up there because we did see that marketplace peaking quite a bit later than Sydney and Melbourne. I should have offered as well, Jeff, if you see any points you'd like to make or any questions that are quite timely, feel free to interject as well.
Yeah, absolutely. Just on that one, I guess, Tim, it's an interesting graph, isn't it? Because it's talking about the rate of deceleration. And Sydney is, I guess, in that sense, outperforming because the rate of its reduction is improving at the most rapid, which is interesting. And it's also interesting to see Brisbane being the most rapid decelerator at the moment.
Yeah, and you know, this improvement with this easing in the rate of decline has coincided with a few other indicators in the market. So we've seen auction clearance rates have lifted in Sydney from the low 50% range to be consistently around about 60% or low 60s. Melbourne's picked up from the mid 50s to generally be around the low to mid 60% range in clearance rates. We've definitely seen a very modest flow of new listings coming into the market, which is probably helping to support prices to some extent. And also through September, we did see a bit of an uptick in consumer sentiment, although that's been partially reversed through October, although still above its August lows. So a few other things that I guess give us a confirmation point that the market has maybe moved through the worst of its cycle. But keep in mind, there's still plenty of interest rate rises ahead of us, at least another 2, I would say, maybe more than that. And we are expecting housing values will continue to trend lower, just not quite as quickly as what they were when that initial shock of interest rates rising started to pass through.
Yeah, it was interesting your comment about the sentiment and the commensurate slight improvement in auction clearance rates. Certainly on the ground, what we saw around most of the Eastern Seaboard's markets was when the rate of RBA cash rate increases reduced from an expectation of 50 basis points to 25 basis points some 3 weeks ago, we saw an immediate bump in consumer sentiment. And I guess that was best demonstrated with the ASX in that short trading period between 2:30 p.m, the rates announcement, and 4 p.m. close of the market. Just in that hour and a half, we saw a 3.8% lift in the ASX. And we saw that improved sentiment flow through to buyer activity or buyer sentiment. But then that was quickly, I guess, reduced by big inflation numbers out of the US and also the situation in the UK that emerged over the last couple of weeks. So sentiment bumping around a little bit there.
Yeah, and of course, we've seen the domestic inflation numbers come out earlier this week, which were higher than expected as well. And no doubt that will probably have a bit of a dent on sentiment, and even seems some speculation the RBA could revert back to a 50 basis point rise on Melbourne Cup Day, though I think that's probably unlikely considering they've now indicated they're moving into a more gradual rate hiking cycle.
I'm with you there, Tim. My money's on 25 for Tuesday. That's 25 basis points, not number 25.
So let's look at this in a little bit more detail then. And I'm just looking at the COVID cycle to date. And by that, I mean, looking at how housing values have changed from March of 2020. Remember, COVID was pronounced as a pandemic on March 11th by the World Health Organization. and looking at how our daily index has tracked all the way through to the 23rd of October for the 5 majors here that we track the housing market on a daily basis. If anyone's interested, by the way, you can look at these daily numbers. They are on the CoreLogic website. The best way to use that index, by the way, is to update the trend rather than to try to do something crazy like annualize the daily or the weekly numbers. That can be quite volatile. But this is exactly the same index we use for our monthly indicator, which is why I use a rolling 4-week trend mostly. But it also gives us an update on what the end of month is likely to look like and how far the market's progressed since peaking or moving through its cycle. So you can see some really interesting, signposts here in the market. We've got Sydney, for example, housing values are up about 28% through the cycle. But since the market peaked back on the 13th of February, we've seen values fall by about 10% in that market. So quite the milestone, reaching a double-digit decline from its peak. But remember, the context is really important. A 28% lift in values, now a 10% drop. In Melbourne, the market didn't see as much growth. Initially in COVID, it saw a larger drop in values, nearly 6%. There was a much stronger reaction in Victoria from a demographic perspective due to lockdowns and so forth being quite a bit more forceful than other parts of the country. So we did see housing values fall further earlier in COVID, then rise by less through the upswing, and now they're down about 6%. 2 capital cities where housing values have absolutely rocketed through the upswing, up more than 40%. But you can see Brisbane is seeing a sharper reduction in the rate of growth. And I think these markets where we have seen values fall further, particularly Sydney, they do tend to be markets where housing prices are more expensive, arguably where household balance sheets are more thinly stretched and households are more sensitive to the higher cost of debt and the erosion of borrowing capacity as well. Whereas in Adelaide and Perth, 2 of the most affordable capital cities, still benefiting from a pretty decent demographic tailwind behind them, and arguably don't have the same sort of household balance sheet stress that we may be seeing in Sydney. You can see that those markets haven't fallen in value anywhere near as much as, say, a Sydney or a Melbourne or a Brisbane, for that matter. Looking a bit more broadly and across some of the other smaller capital cities as well, you can see the growth cycles have been quite diverse. Adelaide and Brisbane really stand out across the capital cities, and Melbourne in terms of a softer growth cycle. But look at the regional markets. We've seen regional housing values at a really broad level increase by about 43% through the upswing, but values in these markets are now falling as well. In fact, if we look at the regional index more broadly, you can see it has been relatively lagged in the sense that regional markets moved through a peak later than the capital cities and showed a stronger growth upswing through the growth cycle. But you can see the downturn is now quite sharp and following the trend line of the capital cities. Most of that weakness is being driven by what you might describe as your usual suspects, your major capitals just outside of the metro region. So a few examples of those areas here. These are some of the largest regional markets within commuting distance of the major capitals. You can see each of them has recorded quite the spectacular growth trend, especially markets like the Southern Highlands, the Richmond Tweed area that includes Byron Bay, the Gold Coast and Sunshine Coast. All these markets up around 50, sometimes even close to 60% in value, but all of them also recording a reduction in values now, either in line with the capital city counterparts or maybe a little bit less, a little bit more, depending on which regions we're talking about. I think all these areas have probably seen a structural change in their underlying demand profile since COVID. I wouldn't be surprised if they remain more popular than they were pre-COVID, just simply because we are seeing a lot of companies adopting formal hybrid working arrangements. A lot more people are empowered to work in these areas that are still within that sort of magical 2-hour commuting distance of the major capitals. Once you get outside of that sort of 2-hour buffer of the major capitals, you can see a lot of the regional trends haven't been as strong through the upswing. Markets like Cairns or Townsville in Queensland are getting down to some of the Riverinas or the agricultural markets around New South Wales and Victoria, the mining regions as well, have all shown very different dynamics, just highlighting they haven't had the same demographic tailwinds behind them, like a lot of these commutable lifestyle areas that have really benefited from a demographic shift and increased popularity. Earlier on, they also had quite an affordability advantage in a lot of these areas, but that's largely been eroded now due to the fact that they've seen values rise so much through the upswing. So I might just change tack a little bit. Anything else you wanted to add in there, Jeff, around the trend in values before I move into sort of listings and
No, nothing else there, broadly consistent with what we've seen.
Okay, let's look at listings first. And the listings trend has been quite different through spring. You can see the graph on the left where I'm tracking the volume of new listings coming into the market. We're measuring this on a rolling 4-weekly basis. And each one of these trend lines is a calendar year, with a really dark trend line being the year to date for 2022. These sort of graphs are really useful for comparing highly seasonal data, like listings is a really good example. And you can see around this time of the year, there's normally quite an uplift in the flow of new listings coming into the market. So people describe this as, the spring selling season or the spring listing season. You can see why. But this year, we haven't really seen much of a spring listing season. It's just starting to pick up a little bit over the past month or so, or the past couple of weeks, but nowhere near what it has been over previous years. So across the combined capitals, we're seeing the flow of new listings is nearly 25% lower than it was a year ago, and about 17% down on the previous 5-year average. So it looks like at the moment, prospective vendors are just waiting this more challenging selling time out. They're sitting on the sidelines, probably waiting for either a bit of certainty return to the market or for selling conditions to start improving. The other thing it really tells me is there's no signs of panic or distress or forced sales coming into the market. Quite the opposite, I think, where the large majority of property owners that may have been considering selling are probably delaying their decision until the market improves a little. But in the same sense, on the graph on the right, looking at the total number of listings, this is total advertised inventory, you can see it's holding pretty firm. It's not showing the same reduction as what we've seen in new listings, which simply means the rate of absorption has slowed down. There's a few positives and negatives about that particular trend. It implies that the number of sales is reducing, and I'll show you that in just a moment. But it also highlights that overall stock levels remain quite contained. Total stock levels are about 4% lower than last year and about 17% below the 5-year average. So there is a bit of a shortage of supply in the marketplace. That's probably one of the factors that's helping to hold up housing values or prevent a larger reduction in the rate of decline. So flipping over to the demand side, the number of transactions in the marketplace, again, I'm looking pretty macro here across the combined capitals. You can see the number of home sales is reducing, moving through record highs about December of last year, but still a little bit above average, both for houses and units. You can see the number of home sales for houses tracking around about 5% above the 5-year average. For units, pretty much bang on the 5-year average. My guess is it probably will continue to trend lower. We will see activity trending lower as interest rates rise further and we see a further reduction in borrowing capacity. But I'd be very surprised if we saw transactional activity getting substantially below that 5-year average, simply because there's always going to be some churn in the market. There's always going to be a need for people to upgrade or downsize, move because they've got a new job, that type of thing. So there is a base level of demand that seems to be quite evident in the market.
They're really interesting charts, those ones, because when you speak to participants, and there was a commentary that I made in one of the newspapers this week, when you see participants in some of the specific markets, it's almost as if the sky is falling in because there's no activity whatsoever. But when you look at that chart, we're actually nationally slightly above the 5-year average. It looks rather benign, but I think there's a chart coming up or a table coming up, Tim, where it shows the diversity in the different markets. For example, I think you'll see Sydney volumes down something like 31%, whereas Adelaide is up by, that's it, by some 18%. So there's significant diversity in different geographic markets.
Absolutely. And this is so important. You know, the headline numbers and the macro figures are very important for policy and for understanding the broader trends. But when you start peeling back the layers of the onion, so to speak, and look at the different geographies in more detail, to your point, Jeff, you can see Sydney home sales are down about 31% compared to the same time a year ago. I'm just looking at the September quarter this year compared to the September quarter last year. And from the column at the end of this, on the right-hand side of the table, you can see sales is down about 21%. Melbourne, the year-on-year comparison's a little bit iffy, just because Melbourne was moving out of a lockdown at this time last year. So the year-on-year comparison's probably not great, but Melbourne a little bit above the 5-year average, Brisbane about 15%, even though volumes are down about 20% year-on-year. And then, as you say, going to Adelaide and Perth, where housing is much more affordable, the demographic profile is generally quite positive, particularly in WA, where the economy is substantially stronger than what it was a few years back. You can see that sales activity is even higher than a year ago. One of the biggest impacts looks like Hobart at the moment, where we have seen volumes fall a bit further, but listings have risen quite substantially in that market as well, to be a little bit above average now in the Hobart market. But that's after a very long period of very strong capital gains. Regional markets coming down in volume as well, apart from SA and WA also. So what happens when listings start to normalize and we see activity coming down? Well, obviously it becomes a market that's a little bit more aligned with buyers rather than sellers. You can see that in a whole bunch of indicators. Clearance rates, you can see the clearance rates as we were going through the growth cycle was generally up around the high 70s to 80% range across most of the capitals. We're consistently now seeing clearance rates more around the 60% range, although it has improved from, as I mentioned a bit earlier on, back in August, Sydney was down around the low 50s, so was Melbourne. Both of those markets have seen a consistent improvement in auction clearance rates to bring them in around the low 60% range, still well below average levels, but not as severe as what the markets were a little bit earlier. That's probably reflective of a couple of things, but most importantly, it'll be reflective of vendors becoming more willing to meet the market. There's always going to be an adjustment period, particularly when you come out of such a strong growth phase, where vendors take a little bit of time to adjust to the new market conditions, which are now favoring buyers. We can also see it for the private treaty metrics. These metrics exclude auctions, so they're based on a listing price and a listings date and a contract price and a contract date. So you can see homes are taking longer to sell, not extremely so. A 32-day average across the capital cities is actually still a pretty healthy number. But when you look at the level of vendor discounting, which is on the next page, you can see that's had a much sharper reduction. So what that tells me is that vendors are becoming more comfortable or more flexible in reducing their pricing expectations in order to sell their property within a reasonable number of days on the market. Maybe this reflects vendors becoming more concerned that if they don't sell relatively quickly or become more flexible, then it'll become harder to sell down the track, or the property value will continue to fall. So it makes sense to me that we would see vendor expectations becoming more malleable, more flexible as the market moves through what's been quite a rapid downturn to date. Rental markets. Anything you wanted to add before I move into the next topic, Jeff?
No, nothing else other than what we're seeing on the ground is rental is becoming increasingly a hot topic. So much we've seen sales prices as being the focus, but increasingly we're seeing so much more discussion, and the data that you're about to run through will show exactly why.
Yeah, rents are very different in the cycle. So housing values tend to be quite sensitive to interest rates, whereas rental markets are purely a byproduct of rental supply and rental demand. Sure, investors will try to pass through rate hikes or a higher cost of debt onto rents, but when the rental market is really loose, they simply can't do that. The rental market won't tolerate higher rental prices when there's a high vacancy rate. But the reality is, at the moment, vacancy rates are extraordinarily low and they're not budging from record lows. So let's look at some of the metrics here. We're seeing rents nationally rising at about 10% for all dwellings, faster for units than houses. Quite the turnaround for what we're seeing through the earlier phase of COVID, where the unit market was quite weak for rental demand. I think the real acceleration in unit rental growth comes back to two things. One being domestic rental demand is now transitioning quite quickly towards the cheaper side of the rental market, being medium to high density, simply because renters are really facing quite stiff affordability pressures. The other one, of course, is net overseas migration has absolutely rebounded with some strength. In fact, the March quarter reached a new record high on net overseas migration. Bit of catch up playing out there, no doubt. So let's see what happens over the rest of the year. But all that overseas migration is funneling directly and immediately into rental demand, particularly around the inner city apartment markets. So you can see across every capital city, there's quite a bit of upwards momentum in rents, particularly on the unit side of the fence. House rents tend to be more expensive, which is probably why we've seen the rate of growth easing off for house rents. We're probably also seeing some early signs now of household or rental households reforming, restructuring to become larger, reversing that trend we saw through the pandemic where rental households became smaller as they utilized, say, the second or third bedroom for a home office, as group households broke up to become couples or single persons. I'd have to guess that trend is already reversing simply out of necessity as renters look to spread their rental costs over a larger pool of renters under the one roof. To my point a bit earlier on around rental supply, exactly the same graphs as what I showed a bit earlier on for sale inventory, but this is for rent inventory. You can see the trend is still firmly down. There's no evidence of rental supply coming into the market from a listings perspective, or also from a newly built perspective, although maybe that's around the corner. If we look at rental markets around the country, obviously most of the rental supply is very much skewed towards the biggest capital cities. So Sydney, for example, accounts for about 23% of national rental supply, Melbourne about 19%, Brisbane about 11%, regional Queensland 11% as well. So it's kind of interesting to see where rentals are dispersed, but it's fair to say that wherever you are in the country, regardless of if it's a regional market or a capital city, vacancy rates are generally at record lows, and it's very rare to find somewhere that's showing any evidence of vacancy rates starting to rise. So to Jeff's point a bit earlier on, I think the focus on rental affordability and introducing more rental supply to Australia's housing market is going to be where a lot of the conversations from a policy perspective go. You would have seen it in the budget that came out a bit earlier this week. A lot of the funding from the housing accord, that $350 million that the government's put up, is really there to fund rental subsidies, to incentivize superannuation funds or institutional investment to build rental stock or build to rent and put it into the marketplace at a lower than market rental price, where the government will top up the rent and try to make that an appealing investment for those institutional investors through topping up the rents through subsidies. Another way we can look for rental supply is any sort of a bounce back in investment activity, and we're clearly not seeing that on the housing finance data either. We'll see an update on this data to September early next week. On Wednesday, we'll see an update on this data. But you can see really clearly the investment trend, the graph on the far left, has been falling pretty sharply since interest rates started to rise. And you can see that in the two graphs on the right, just tracking the peak level of activity from a mortgage perspective. You can see investor lending's down about 24%. But since the first rate hike, from the end of April, you can see investment lending is down about 20%. So first home buyers much more sensitive when we saw all the fiscal support being removed back in March of last year, and affordability sensitivities. But investors seem to be much more sensitive to higher cost of debt, probably a little bit more caution coming out of the lending sector. And also investors are very motivated by capital gains. So my guess is, as we see the dust settle on rate hikes and housing prices starting to stabilize, that's where we'll start to see investors becoming more active in the housing market. Vacancy rates, absolutely at record lows, around 1% pretty much everywhere, if not less than that. Like Adelaide's at 0.3%, Perth's at 0.6% for vacancy rates. Most other markets around the 1% mark. Again, we're not expecting vacancy rates to rise anytime soon. For that to happen, we'd have to see either a reduction in demand or a lift in rental supply. Demand will probably reduce domestically simply due to that reforming of household size. Households becoming larger, that will de-amplify some of the rental demand we saw through the pandemic, but that will probably be more than offset by rising net overseas migration. For investors, though,
sorry, Tim, one of the things that we're seeing that's fueling that situation with rents is the extremely low vacancy. Prospective tenants are actually starting now to bid against each other. And that's exacerbating the issue because the landlords are having these increased rents put to them to select tenants. And so that's then feeding off itself.
Yeah, no doubt. And you can just see some of the media reporting as well. There was one just last weekend on a Sydney apartment that had a queue of prospective renters that was snaking all the way down the street. So yeah, I think it's going to be with us for some time yet. But for investors, there is a bit of a silver lining here, meaning that yields are starting to rise. So that's the byproduct of really rapidly rising rents and falling housing values, is this trend towards yield recovery. So I wouldn't be surprised if we do see gross yields getting back to around average levels within the next 12 months, if not earlier than that, simply due to the fact that rents are going to continue rising. Housing values will continue to fall for a while and then stabilize, leading to an improvement in rental yields, albeit off record lows through the pandemic. And just to wrap things up, a few slides on where to from here. I think the key things we need to be watching for from a risk perspective, interest rates are going to be the main one. I've said many times that the housing trajectory or housing value trajectory is very much intertwined with where interest rates find a ceiling and how long they take to get there. We've recently seen a lot of the mainstream cash rate forecasts get boosted up simply due to the really high inflation reading we saw for the September quarter. So even though headline inflation is starting to come down a little bit, the growth rate's coming down, core inflation, which strips out some of the more volatile items, is still rising, and it's mostly being driven by non-discretionary items. Things that we can't really control our spending on, like fuel and utilities, building costs, rents, that type of thing, really driving inflation at the moment. So I think the sheer range in cash rate forecasts, which generally go from about 3.1%, CBA, for example, are forecasting a 3.1% cash rate by Q1 next year, whereas Westpac and ANZ are all the way out at 3.85%. Financial markets still a little bit above 4% for a terminal cash rate. So that range really just highlights the uncertainty. Sorry, Jeff.
Where's your forecast, Tim?
I'm a 3.1 percenter, Jeff.
Spot on, so am I, happily.
Maybe that's a bit of a glass half full approach. It's also the median or the consensus view, I guess, so the median on economists surveyed by Bloomberg just recently as well. That may go up a little bit, I think, on the latest inflation forecast, but we'll see. Hopefully we're right, and it is going to be an early sort of 3% range where the cash rate finds a peak. Another maybe piece that the RBA would be looking at around where they draw a limit on the cash rate is going to be the serviceability buffers in place from APRA, 3 percentage points above the going mortgage rate. Considering we've already seen the cash rate lift by 2.5 percentage points, no doubt next Tuesday it'll be up another 25, maybe 50, but doubtful. We're getting pretty close to that 3 percentage points ceiling or buffer that APRA has imposed on borrowers since October last year, and that'll be quite a benchmark that the RBA would be wary of, I would presume, because once you start getting beyond that level, that's where you start to get higher risk levels around mortgage arrears and mortgage distress. There's also the refinancing cliff around the corner. So from about April to May of next year, we'll start to see a lot more refinancing activity as a lot of fixed rate mortgages get reset onto variable rates. So that means a lot of those fixed rate borrowers, which was nearly half of all borrowing at the sort of the peak around July of last year, they'll be going from a mortgage rate of about 2% to somewhere around the mid-5s, if not higher than that. But no doubt lenders are already, coaching those borrowers to make sure they're budgeting for this, that there's not going to be a shock factor when they come to that. Affordability, that'll pivot more towards serviceability rather than getting your foot in the door of the market, but still affordability going to be a challenge. A few other ones there. I know I'm running out of time, so I might just flick on to a few scenarios on where to from here. But I suppose just offsetting some of that risk is labour markets, even with a new budget forecast of unemployment getting up to 4.5% by the end of 2024, that's still a full 1 percentage point below the decade average for unemployment. We're still going to be having very tight labour markets that helps to protect mortgage distress. Mostly people who want a job, have a job, wages are going up as well. There is, hopefully we can avoid a recession here in Australia. That's generally due to the fact that we're very resources intensive. And as other countries move into recession, they tend to stimulate their economies through a lot more building activity, which Australia's the beneficiary of, and migration also quite stimulatory. Which you can see the graph on the right here, that surge bounce back in net overseas migration has been nothing short of spectacular. Definitely favouring the Sydney and the Melbourne markets. A lot of overseas students coming back, skilled migration coming back as well, but also a bit of a change in the interstate trends as well, which again provides a little bit more of a tailwind for Melbourne and Sydney as they see fewer people leaving those cities or those states. Queensland, WA and SA still well and truly in positive interstate migration though. So where to from here? Well, the forecasts for housing markets are just as diverse as the cash rate forecasts. The consensus among most of the mainstream forecasts is for about a 15% drop in housing prices across the combined capitals, larger falls in Sydney and Melbourne, smaller falls in markets like Brisbane, Adelaide, Perth. But time will tell. Another way to look at these sort of forecasts is just to do some scenario testing. Well, how much will we need to see values fall before wiping out all the COVID gains? Well, markets like Brisbane and Adelaide would need to see values fall by around 30%. Well, Brisbane 26, Adelaide about 31% before they're back to March 2020 levels. But remember the graphs I showed you on Melbourne where they had a larger fall earlier in COVID, a smaller upswing about 17%, and now values are down about 6%. We'd only need to see about another 4% drop in Melbourne before the market's back to March 2020 levels, Sydney about 12%. So again, quite a bit of range there. And again, you can sort of see these scenarios. If we did see, say, the 15% drop at a macro level, that's taking our index back to where it was in about April of 2021. A larger 20% drop takes our index back to where it was in January of 21. That's pretty similar to where the market was around late 2017 as well. So these scenarios tend to vary quite substantially from city to city. It does look like Melbourne's quite a bit more exposed to homeowners moving into a position where the property value could be worth less than what they paid for it. But if you've owned your home for a longer period of time, obviously that provides some insulation. Brisbane and Adelaide, clearly the most insulated, as well as Perth, where it has had quite a strong upswing lately, but remember, quite a weak period between 2014 and 2020 as well. So we did see larger falls in that market. It could be quite an interesting environment for homeowners there. But my guess is Perth is going to be quite the strong market going forward once we get through this patch of higher interest rates. So Jeff, I'll leave it there. I think we've got plenty of time for questions now, and I'll hand over to you.
Yeah, thank you, Tim. We do have some time. Just on some of those data points, what we're seeing, and I'm not sure whether I could be bold enough to ask you your forecast for national city prices for calendar 2023. You can take the fifth on that if you'd like.
Yeah, absolutely. So we're probably not quite as pessimistic as a lot of the mainstream forecasts. A 10 to 15% drop at that macro level from peak to trough would be broadly our view, but there probably is some downside risk to a larger drop if we see interest rates moving higher than what we're expecting. You know, to our conversation a bit earlier on, 3.1 hopefully is the peak in the cash rate, but beyond that, that probably opens the market up to larger falls. And like I've said repeatedly, it's going to be very much dependent on where interest rates land as to where housing prices land as well. There's just so much uncertainty. So 2023 will probably be maybe a year of two halves, some declines through to earlier in the year, depending on where the interest rate finds a ceiling. But hopefully, if we start to see stability in the interest rate environment, inflation coming down, and wages growth, that should start to gradually fuel either a stabilization, but maybe even some subtle growth returning to the housing market, especially as we see more renters looking to buy, because we're not expecting those rental pressures to really be alleviated. So buying conditions will probably be quite favorable. But as soon as interest rates start to come down, I think that'll be really the catalyst for the beginning of another growth cycle. But of course, the timing of that's virtually impossible to predict.
And so therefore your prediction on the percentage reduction or increase for calendar 2023, and we're not going to hold it to you.
Thanks for that, Jeff. I'd probably say net somewhere between 0 and 5% down over the year. But again, probably more skewed to some negative movements earlier in the year, some stabilization through the middle, maybe a little bit of an uptick towards the end of the year. So
remarkable. And I'll show the viewers this if possible. I actually had that 0 to minus 0.5% from the agency as well, but it was written down prior to you answering. We'd see that as well. One of the interesting things that we're seeing, though, is it is going to provide an environment during 2023 where it's a safer environment to transact. Over the last 2 years, we've seen vendors reluctant because they don't want to be out of the market because of the risk of it running away. And we saw that with increases annually of some 10, 15, maybe even 20, 25%. And so that in itself was a friction point to transactions happening. And indeed, the worst thing to Australians being able to move home when their family requirements were needing that. And so this new environment that we're going into, and we all know, certainly the older ones amongst us, that housing shouldn't be speculative and you should have a lower volatility in prices. We see an opportunity for people to feel safer in transacting because the market won't run away from them. Indeed, it might be a little bit softer when they come to buy. So I guess that's one of the positives about this period. The other thing, of course, is first home buyers. Now, yes, the cost of borrowing is going to be significantly increased to what it was, but invariably first home buyers, and you will have heard in the budget about the lack of wages growth that is expected in the next year or 2 years. But first home buyers are invariably people who are on a stronger trajectory of career growth due to their age, but they're also a position of being savers at the moment. And those savers for some 5+ years haven't seen any interest. Now they're seeing that their savings amounts are actually accruing interest as an incentive to further save, and they're getting in a stronger and stronger position to then start to participate in home ownership, which we see also as a positive. I guess you'd expect me to say that, but that's something that we're seeing emerging in this new environment for next calendar year.
Yeah, first home buyers will be an interesting one to watch. We did see a lot of demand pulled forward through COVID due to things like incentives and, well, a combination of incentives, particularly first home buyers using the grants together with Home Builder, for example, to get into the market. So if we do see further incentives being launched into the market, we know first home buyers will be very sensitive to those. We are seeing quite a few state and federal initiatives for first home buyers as well around shared equity arrangements, low deposit guarantees and stuff like that, although quite limited in the numbers and in the eligibility criteria as well. And another incentive there for first home buyers will simply be that rental markets are going to be incentivizing renters to become first home buyers simply due to, doing the numbers. It may be the case that it becomes more affordable to pay down a mortgage than pay off a landlord.
Indeed. A couple of questions before we do wrap up. Tim, you mentioned you're not seeing any signs of distress in your figures as yet. What do you look for in the data that could suggest or indicate that may have changed?
Yeah, there's quite a few things we look for in our own data and externally as well. So the main one would be looking for any material uptick in the new listings trend. which would demonstrate that there's either some panic where people are motivated to offload their properties into the market, or they're forced to offload their properties into the market. There's no real evidence of that, or there isn't any evidence of that anywhere. The other thing we look for is look at the bank reporting. So ANZ, for example, just reported their annual results, and they actually reported a drop in their arrears rates. 90-day arrears is the main sort of measure of mortgage distress, or once you get beyond 90 days, that's where you're starting to go into a cycle of repossession. So the 90-day arrears rate's down. Even through the latest figures being reported by the RBA was showing the 90-day arrears rates around that sort of 0.5% mark, which is below the long run average. It was more like about 0.6, 0.7. So once you start to see 90-day arrears getting up into, say, the early ones or mid 1% range, that's where you start to see maybe a little bit more challenges from the household balance sheets. But even at 1.5% as an arrears rate, that's still quite low. WA, for example, didn't get much higher than that, even through the worst of their downturn when unemployment was quite high. So that'll be one to watch. We might see arrears getting a bit higher as we move through this refi cliff that I was talking a bit about around April or May of next year. But my guess is really tight labour markets and rising incomes should help to manage that.
Sure. A couple more just before we go. Where do you see the Gold Coast market, especially with the lifestyle and interstate buyers and the infrastructure within the Gold Coast over the next 6 to 12 months for the Gold Coast?
Well, prices will probably continue to fall over at least the next 6 months. Prices are falling across the Gold Coast at the moment and the Sunshine Coast and Southeast Queensland more broadly. But beyond that, you'd have to think that market is going to be relatively a good option for investment or for either stability or growth in values. You've got the unit market there is arguably undersupplied after a long period of not a great deal of new development and not much in the pipeline. You've got a market that's become much more popular than it used to be now that hybrid working arrangements are available. You've got a lot of infrastructure planned in the lead up to the Olympics across Southeast Queensland as well. And there seems to be a renewed popularity of lifestyle markets as well for all those reasons I was mentioning around hybrid working and commutability back into the major job nodes. So I think the Gold Coast, and I'd probably include the Sunny Coast in that as well, are quite well positioned for medium to long-term growth. Toowoomba, I'd say even better, even though it's not a coastal market, but I'd include it in Southeast Queensland. Buying into Toowoomba is cheaper than buying into Ipswich. It does have some lifestyle appeal for those people looking for more of a hinterland location, pretty strong economy, great airport, quite a bit very progressive as well. So I think I'd throw Toowoomba into that Southeast Queensland basket as well, which I'd be fairly optimistic about.
Perfect. Yeah, we're big fans of Toowoomba. And so therefore, you see the Olympic Games in Brisbane as a growth opportunity for Brisbane in particular and also Southeast Queensland?
Yeah, absolutely. And there's a lot of hype around the Olympics coming up. It's not about the Olympics per se. It's really about the capital works and the capital investment and infrastructure in the lead up to the Olympics. It creates jobs and provides productivity improvements and commutability improvements as well. So that's really what's going to be driving, I think, the positive outlook for the Southeast Queensland corner is that blend of strong population growth, a huge amount of infrastructure investment, and still that lifestyle appeal and a relative level of affordability compared to Sydney.
Very good. And just the last one we've got time for. Any specific views on the ACT and Canberra market, Tim?
It's generally a pretty stable market. It doesn't have the same level of volatility as what we see in larger capitals like Sydney and Melbourne. It probably has something to do with the political environment and stability of government or political related jobs. So I think, even though we are seeing housing values falling in the ACT at the moment, they seem to be managing supply quite well in that market. There's been some good infrastructure projects coming through, not a great deal of new supply in the pipeline. The unit market there has really been quite challenging up until the past couple of years because it has had a lot of supply come in, but that seems to be resolved now. And if anything, maybe even undersupplied. So yeah, I think fairly positive on the ACT market. simply based on its history being quite stable and also quite strong rental yields as well.
Terrific, and thank you. Well, Tim, once again, thank you so much on behalf of all of the attendees here. Fabulous insights into the national residential property market. I know we certainly enjoy it, and we use a lot of your information to structure the direction of our business and our activities. So really appreciate that, and very much looking forward to having you again soon. And thank you everybody for attending. I'm sure you can contact either myself or Tim if you've got any other further questions. But have a wonderful afternoon and a great weekend. And Tim, look forward to being in touch soon.
Many thanks, Jeff. Thanks, everybody.
Thank you.